future. We're talking real money.
The reality starts right now. We are going to give you real information on a really important topic because, it's your life that this thing fuels. It's called money. And this is Talking Real Money. I'm Don. Tom's over there shuffling paper madly. I don't know what he lost, but he's looking.
No, I'm not angry. No, not
You're
mad.
just shuffling paper.
Just moving it around. That's what they pay me to do. So I'll keep doing
he's a
it.
paper shuffler. Well, yeah, you know what we think of them.
Exactly.
Hi, everybody. I'm Don. I don't know what he is. 855-935-TALK is our phone number, 855-935-8255. And you've heard the saying, what you don't know can hurt you. Well, what you don't know it can hurt you forever. It can hurt you financially in ways that can totally change your future. And Tom, what's the cost of a lack of knowledge? I mean, can you put a price tag on it? Has anyone ever tried to do that?
Well, the National Financial Educators Council, thank you. That was really nice softball. The National Financial Educators Council
Who the heck
shows that
they?
40%. This is a survey now. This is a survey. It shows that 38%, 40%, 4 out of 10 individuals in a recent survey said their lack of financial literacy cost them at least $500 in 2022.
Where do they get that number?
I think that's absolutely nuts. 15% said it set them back by $10,000 or more. I will guarantee you, if you're an investor, it's costing you way more than that. Way. It's not even close. 70% said their lack of literacy cost them from $0 to $500. I mean, this is silly because I look at these portfolios almost every day from people that use actively managed funds, from people that have advisors, from people, all kinds of mistakes that are costing people thousands of dollars a year, not $500, not even $1,000. And we're talking thousands of dollars that you're handing out. Now, the reason they don't know that is because of the following. They don't see it. They don't get a bill.
But maybe they're talking about everybody, like people who don't invest, that their lack of financial
literacy, which is half of the people.
Yeah, that may have cost them some extra fees from their bank or that kind of thing.
Well, yeah, and which are not insignificant because, again, if you go use an ATM or if you use a debit card, those things have charges, again, that most people don't consider. They're happy to take $100 out and pay $3 to get it or $4 or whatever it is today. It's expensive.
I think there's another old saying that applies here, and that is, you don't know what you don't know.
Exactly.
And there's a lot that you don't know.
I mean, so this is, and they get into, by the way, that the lack of knowledge goes back to most people don't get any through the public school system, which is very true. It's a very small number. It's, I think, less than half the states has any education for young people around money, which I think is tragic because there should be some basic knowledge. So, for example, when you get your first job, do you know how much you're going to have to pay out of that for like taxes or what kind of taxes? You should know that. That's not hard.
I don't think
you got to pay into Social Security.
Got to pay right off the bat, particularly when you have to factor in. You got Social Security, 7.5 for that. And then you got your Medicare, which is another something. Then you got
1.5, I think,
taxes. Then if you have any 1099 income, if you're self-employed in any way, shape, or form, add another 7.5 to that for self-employment tax.
It's expensive. I mean, but you need to know that. I also think in a general sense, everyone needs to know kind of what different types of things have made you over the long haul. This is where we get in a lot of trouble because people hear, well, I'll circle the box that says I'm going to make 15%. How's it going to do that? When on average, stocks have made somewhere around 10, bonds have made somewhere around 5, and cash has made
somewhere around 0.
2.
No.
Yeah.
Cash.
But you need to, no. But you need to know kind of a general rule on these things because it's going to cost you way more than $500 if you get that wrong, right? I mean, and here's the other one this isn't education, but it's just sort of common sense. Everything you make, part of that should go saving for your future. Now, it might be saving for a house in the future or a car, your retirement, but it's some of that, you can't spend it all. But most people don't pay attention to that until they reach 40 or sometimes 50 years old. They don't, what, you mean I got to save some of it? Yes, you do have to. Do.
But there was an article I read recently where they, one of the newspapers, I don't remember if it was the Times, the Post, Journal, talked to a bunch of younger people, and they said, saving for the future when I make 40 grand a year is hard. It's really hard.
That I believe.
And you want me to have no life whatsoever? And that's an interesting point, because you hear a lot of people say, well, just cut back on a latte a day and you can save a bunch of money.
Yeah.
But that's taking people's little pleasures away. And really what it comes down to is making better decisions on the bigger stuff. And I think this was some great advice. For example, you're going to get that new TV. Do you need the $1,000 OLED TV, or can you get by with that beautiful 4K $400 TV from TCL or some Chinese manufacturer that isn't Samsung?
And by the way, back to that contention. If at the beginning, let's say when you hit 22 and you've got your first full-time job or earlier, you just set it up so some of the money goes away and you never see it. The discipline you don't have to write a check. It just simply comes out of your account and gets invested. That I know works way better than the alternative.
And we're moving more toward that as the default at bigger companies. The problem is it's generally only bigger companies and organizations that offer these kinds of plans to employees. A lot of very small companies, 1 or 2 or 3 employee companies, don't have the resources to offer them or don't want to pay the price to offer these kinds of programs to employees.
And more of those are coming along. I mean, as part of the recent acts in Congress, et cetera, there's going to be more of those small programs and state ones to help you get started.
We'll talk more about the things you don't know and how they can hurt you and how they can cost you after this.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
I looked up this National Financial Educators Council.
Yeah, that they quote. Yep.
Yeah, their job, they want to teach you and me how to be national financial educators for $2,000 in classes and another $3,000 in certification and tests, and it can be up to $12,000. It's just like, holy cow.
I don't think you need that to teach young people about money on a basic level. No, as a matter of fact, if they were really a financial educators council, what they would be doing is actually training people, not training people to train people. But there's not as much money to be made in training regular people. It's the training people to train people. Apparently, I'm assuming this is a not-for-profit council.
I don't know.
Okay.
No, I don't think so. I think it is a for-profit. Although, I don't know that for sure. I will have to do more research. I was just reading their stuff during the break, which was an unusually short break. 855-935-TALK is our phone number. We'll continue talking about the things you don't know and how they can hurt you. But next, we have Dan waiting. Dan, welcome to Talking Real Money.
Hi. Good afternoon. Hey, thanks, Don, Tom. You've been great, and I really enjoy all your podcasts, and it's kind of fun listening to you. I retired a couple years ago. I just hit full retirement age, but do not, and my wife's 4 years younger than I am, but do not plan on taking Social Security until I hit 70. Social Security seems to have, really nice cost of living adjustment, and that Social Security itself will take care of probably everything outside of maybe $10,000 or $15,000 a year based off of current dollars, today's dollars. So to make up that difference, I was thinking of buying just tips, just doing 5-year tips and a couple of 10-year tips for the next 10 years just to fill that gap for that $12,000. And that just protects that other $12,000 of today's dollars for inflation. And in this last few years, I have done a lot of Roth conversions and other things, and just preparing our portfolio right. But anyway, I'd like your thoughts on that, please.
So you're buying individual tips, is what you're saying? Treasury inflation protected securities, correct?
Yes, that's correct.
Okay.
The tip funds are very confusing to me, and the individual tips, what the base fee and how that interest is paid, seems to make more sense to me. We do have I bonds and stuff alternatively, but I think this is probably a better idea of knowing what you're going to be getting equivalent to $12,000 of today's dollars.
Well, one of the things you need to consider, though, is that all tips are going to do is keep you even. That's it. They're going to keep your buying power even. They don't really make money. And there really should be just a slight money-making component in there.
Well, he said he has Roth, so I'm assuming in the Roth you own something else, correct?
I don't even know what tips. What are tips yielding right now? Are they?
What sort of yield are you getting on those? Is what he's asking.
The base would be like on a 5-year would be like 1.625 plus the inflation factor.
Okay, because they've had a lower base than that. I'm just pulling them up right now.
They were negative a few years ago.
Yeah, they were negative.
Yeah.
So the base is 1.25 right now. Plus inflation. Okay. Well, then, with that's not bad. The problem is in the future when that base rate changes and you're rolling your tips out, that may change your strategy in the future. But for now, I don't think it's a bad thing at all. No, not for what you're trying to do.
We struggle a bit with buying individual bonds, but in this case, you're buying them right from the government, so you don't have any
laddering
markups. Yeah, and you're laddering them out. Yeah, that's probably an okay
Which
strategy.
makes it a disciplined strategy. Laddering makes it disciplined. I just worry about people who buy any kind of fixed income security and then they start fiddling with it in the future going, oh, are rates going up? Are rates going down? Is inflation going up? Is inflation going down? I think I'll wait. I think I'll move. If you're doing a ladder and you keep the commitment to the ladder, then I think it's a decent strategy for what you're trying to do, which is to create that steady income. Thank you so much for the call, Dan. We appreciate it. 855-935-TALK is our phone number, 855-935-8255. And Carolyn, not Carolyn, Jason.
You missed Jason.
Yep. Jason's next. Hi, Jason.
Hi, Jason. This is actually this is Tom. This is another Jason, not the same one.
Okay, new Jason.
I had a question. Yes, new Jason. I had a question. So I'm going onto your topic earlier about, saving money. About 10 years ago now, I decided that, working the job that I was at the time, I wasn't making too much, but I decided to save up all my money and like everything that I could. And then I invested it into my first house. And then instead of living in that house, what I did was that I rented it out immediately. And I still stayed at the place I was because rent was cheaper where I was staying. So the profits that I was making from after purchasing the house and renting it out, I was putting that back into the house. And then when I got a pay raise, I would then put more money towards that house too and paid it off. And then so now, here we are 10, 12 years later, and I have two houses, one that I live in, one that I'm renting out. Now I have about $30,000 in cash assets, and then $115,000 in an IRA. And I'm trying to figure out what should my next step be to continue my asset growth and investment growth.
Well, it shouldn't be in real estate.
Well, or if you're good at it, then why not?
But if you're good, but again, if you're running it as a business, you wouldn't run it as a cash business, though. You probably wouldn't be 100% because you've got too much illiquidity. You got way too much of your money tied up in a or two properties because they're both. You said they're paid off, right, Jason?
Correct. They're both paid off.
Yeah, so let's assume.
That's a good point, by the way.
Yeah, let's assume that real estate does something that it's not supposed to ever do in Seattle, and it goes way down.
Which it may be on the way to right now. Who knows?
I mean, could it fall 50%? Do you think it could?
Maybe. I mean,
Yeah.
If we had like a disaster.
Well, but no, not even a disaster. I lived in Colorado many years in the 90s when we saw real estate prices for some types of real estate, residential real estate, drop by 50% or more.
Yeah, it would be more calamitous than we are today with all the tech layoffs, et cetera. But it could happen.
It certainly could happen, and you've got your money so locked down. Now, that's okay while you're young, but as you get older, it's going to become more problematic. That's why we think you need, if you're going to run real estate as a business, run it as a business. But over and above that, you need to invest, and you need to invest in a diversified fashion.
Yeah, and he's got the IRA, maybe an after-tax account to move some of that other money to invest that properly as well. Yeah,
or if you haven't maxed out all your IRAs, do some more of that. But an after-tax account and some good ETFs would make a lot of sense.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
We do love more than any other part of our job here on Talking Real Money, taking your questions. It is truly the best thing we do. It's the most fun we have. And I think it's one of the more helpful things we provide. So give us a call at 855-935-TALK, 855-935-8255. And Carolyn, you are up next. Welcome to our program.
Okay, hi. So I have a question on the Social Security. So I hear people, the financial advisors, talk about, well, you guys should hold off, because you're going to get 8% more if you hold off every year. And that, to me, that is really not an accurate number because everybody makes different amount of money. And so for my case, I waited like a year and a half or thereabouts, and I was just getting like $6 every month more, which was not 8%. So I just wonder why these people just give out information.
Wait,
okay, you got to get the full 8, by the way.
We're talking anecdotal. Actually, do you have numbers? Because I'm thinking if it was you waited a couple of years and it was $6 more, there's something wrong.
Well,
per
let's go
month.
back. Yeah, how big is your benefit?
How small is my benefit? My benefit.
How small is your benefit?
Pardon me. How much? Come on, hit us.
It's 1281.
1281.
Okay.
So it went up like a little over $100 this past year, but when I started, I was watching, and it was only going up $6 a month, which, and my starting number was, I don't know, $1,100 or something. So it's not 8%. People need to be aware of that. By waiting, you don't get automatically 8%. Everybody's going to have an individual amount. Okay, yeah, you're winding all these things around. First of all, prior to full retirement age, it is not a full 8%. But after your full retirement age, I'm going to have to argue with you here. It is a full 8% a year.
As a matter of fact, Carolyn, if you started at $1,100, then per year you would have gotten an $88 increase per year.
Plus inflation. There's some inflationary part to it.
If I was 70 or something?
If you had reached FRA and you just kept waiting, like
full retirement age.
If your full retirement age was $1,100, let's say, for example, $1,100 at full retirement age, whatever age that was. If you waited 1 year, the next year it would have been about just under $1,200, $1,188 plus inflation.
And inflation, right? Whatever they adjusted it by. Yeah.
So if you waited until 70, you would have been looking at about $1,300. No, you're right. At $1,000, it's not big increases because 8% of a small amount is a small amount.
Good point, but it is still nonetheless 8%.
What I'm trying to say, mine was only going up $6 a month, which is not 8%.
Ken, I have looked at these. I have looked at hundreds and hundreds and hundreds of these for people. And I would have to look at your particular situation because that sounds totally aberrant. I'm looking at mine right now, and mine, I sat here and just did the math. Mine is 8% per year.
Mine is too. I'm hoping to wait till age 70 to take it so I get that full.
Maybe for low-income people.
No, it has nothing to do with your income.
That's not the way it works.
No.
Has nothing to do with your income. And if it was that low, here's what you should do. You should go online to ssa.gov and contact them. There's a Get Help button in the corner, and tell them the situation. Maybe they made a mistake, or maybe they can explain it to you better than we can, because without knowing your particulars, it becomes just an anecdote when we've seen evidence, actual evidence, that people are getting an 8% annual increase. Thank you for the call.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
If you have questions, we will try to give you answers at 855-935-TALK, 855-935-8255. I'm Don McDonald. Tom Cox hanging out over there in the aircraft hangar, looking for a place to land the big B-1.
B-1B is going to have a tough landing, man. That thing is humongous. It's 3 feet by 3 feet. I honestly don't know where it's going to go.
At least you're not trying to put a B-52 in there.
I think they're of equivalent size, actually.
Are they really?
So, I believe so.
Wow.
Yeah. B-1B, I think it's 150 feet. Anyway, it's a big plane.
Big plane.
Not going to make it here. I think it's going to have to be, as you pointed out, different room. So I'll have to get permission.
You could seal it better and fly it out in the yard. And to some people, it would look like
last about 30 minutes,
like a bombing illusion. It would be like,
what's that plane doing there?
Yeah. 855-935-TALK is our phone number. Give us a call. We're talking today about, or in this episode, in this hour, about the things you know and how much they can hurt you. And one of the big things that we talk about that we believe most of you don't know is what you pay for the investments you are in. How much do you pay to the person providing advice? If you have someone providing advice, you're paying them something, even if they say you're not. You are. What do you pay in commissions, either up front or along the way or on the back end? What do you pay in management fees and trading expenses and other things? What do you pay on an annual basis for advice? Do you know those things? Because the amount of hurt we're talking about, if you invest $100,000 with almost any stockbroker, they call themselves financial advisors, who put you in a loaded mutual fund, you are going to hand over, one way or another, about $5,000 on that transaction.
Literally the worst day in the history of the market.
Yeah, well,
yeah. And here's the other one.
It's a bad
5.75%. It's a bad day. Yeah, I mean, okay, you're right. 1987, the Dow lost 22% in one day. Okay, I'll give you that. But here's the other ones that drive me nuts. Yes, the expense ratio on mutual funds and ETF. Almost no one knows what that is.
No.
C-shares, almost no one knows that they're being continually charged. It's sneaky. But here's the other ones that drive me nuts. Equity index annuities. Well, I'm not paying anything for that. Well, yeah, you kind of are. I mean, you're not paying it directly out of your pocket.
You are.
Yeah, it's money that you're not getting.
Right. It's money that you're not getting. And if you want to get out before a term is up, whatever that term might be, you are going to pay a big chunk of money, somewhere between 10 and 1%. If you and if you buy one of these, the person selling it to you is going to collect up front somewhere between 7 and 8% in a commission. That's real money, and it has to come out of one pocket. It's got to come out of your pocket.
There's nobody at the insurance company that just loves you. And by the way, we had one of those. Remember that came in a couple of years ago. We figured out that the person selling the annuity made $37,000 in one afternoon. Do you think they're incentivized to get you into that product?
Yeah.
Pretty much.
Yeah, and even though you don't feel like you pay it directly, the fact that you pay it affects you, and the fact that they're getting it affects what they're selling you.
Of course,
see, there's also
does.
that hidden cost. Are you going to make as much money on the product as they claim you're going to make, as you think you're going to make? And the truth is you won't. On an indexed annuity, you will not make the returns of the market because the insurance company has to make the money between what you make and what the market makes to pay the sales guy and for their big building and all the people who work in it.
And then the other one, and I know we got calls waiting, but the other one is I'm making 10% a year on my annuity. No, you're not.
Oh,
they're going to give you 10% back.
No, is anybody giving a 10% immediate? No, nobody's giving a 10%
but all people hear is 10%, and they think that's what they're making.
I mean, you might get 7% immediate, and you're not making that. You're making 3 or 4. It's your own money coming back at you.
I know. So there's all kinds of ways that this industry tricks you into believing that A, you're making more, B, you're paying them nothing, and that you're paying them. Trust us.
You need to know this. Don't just trust. Verify. 855-935-TALK is our phone number. Give us a call. It is absolutely free. It's so easy. And by the way, you can do it 24 hours a day, 7 days a week. It's just that easy. George, you're up. Welcome to Talking Real Money.
Hi. I've been using the Merriman 10-fund Vanguard portfolio for years and years and years. And I was wondering how those returns compare to your 1, 2, and 3 fund portfolios. If it's worth all the rebalancing.
It probably
I'm pretty
is.
sure since it's Paul, is way less than ours. It just goes without saying.
Well, because it's Paul, but
no.
Okay, well, I'm looking at
here's the reality. Go ahead.
I'm looking at my statement comparing this year's to last year's. 1 year, I was down 14.7%. So you have
now, but how is yours structured? That number doesn't really matter. It's what your stock bond percentage is. Or is this just the equity?
No bond. It's 100%. It's the 10 stock funds.
Oh, it's the 10 equities. Okay.
Yeah. Okay. Yeah. So here's the reason that over time, I would expect the 10 fund to make more over time.
Okay.
Mm-hmm. The free 3 fund portfolios we give out tend to be, even though we don't want them to be, more in large and more in growth than you would get in Paul's 10 fund portfolio because he specifically goes out and buys those funds. In the kind of the global market funds that we recommend, which are simple, they're designed to kind of get people going, you have to end up owning more of those large U.S. firms. It's just the way those are set up. So you end up with more of that, which over time should underproduce small in value. It won't all the time. The last 10 years, our portfolio may have done better than Paul's because large and growth has done better.
No, actually, because when you look at just the equity component of our portfolios, basically what we're saying is you want to own a total U.S., a total international, or just a total market fund along with the bond fund. And last year, the Vanguard total stock market index lost 18%. Paul's only lost 14%, which tells you that tilt to small in value and that greater diversification actually did make you a loss, made you more money.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
And comparing how one portfolio plays out against another is a tricky little game. You have to be very, very careful with the periods. And the longer the periods you can compare, the better off you're going to be. But for some funds, you just don't have that kind of time frame. But we would expect over time, long periods of time, like 50 years, which is what Paul uses, that the 10-fund portfolio is likely to do a little bit better than a 2-fund portfolio or a 1-fund portfolio.
And here's the trade-off. 10 funds is more time. Mm-hmm. 10 funds is frankly more because you got to rebalance. You got, things go up, things go down. You got to make those changes. And do you do that, on a disciplined approach when something moves out of sync, or do you do it annually? I mean, there's all kinds of other aspects to doing that work that make it tricky. I think the bigger decision always is, Are you going to accept what the market provides? In other words, I'm going to be an indexer because I'll take the returns of the U.S. and international, small, that kind of thing. That's number one. Number two, then you're looking for the products that can do that best. And number three is, if you're going to do it on your own, how much time do you want to spend on this? If you want to make it simple, here's a couple funds, go do that. Not very many people I know either A, buy the right 10 funds, or B, rebalance them properly.
The way it really we found the way it ends up working is when you're young, you do the 2 or 3 funds. You start to build wealth with the simple portfolio because you've got a job and things to do and a family to raise and a life to live. Then when you get older and that portfolio starts to
get
nothing
to do is what you're saying?
Well, no, the portfolio starts to get bigger. Suddenly you're those little tiny incremental changes are bigger dollar amounts.
The dollar amounts go up.
They start to carry more weight. And that's when...
And it's harder. Yeah.
Right. And that's when we find that people make that decision to switch from a DIY to a DIWH approach.
And something you pointed out last week as well, and that is in retirement, beyond the portfolio, there's a lot of other big money decisions to be made that a good advisor should handle. Lots.
That's why.
We just talked about Social Security.
That's why you're going
there's all these other
to
things.
DIWH, which is DI with help. Do it yourself
exactly.
with help. Because you're always going to be involved in the process. With a good advisor, you should be intimately involved in the process. I mean, they should keep you informed all along the way about major changes to your situation, and you should keep them informed about changes to your situation that can impact your portfolio and your future retirement. Which is the goal. That's the goal.
Yeah, that plan should be a living document that gets changed. In fact, I'm meeting with my advisor next month to talk about changes. And by the way, one of the changes, I'll say it publicly, you're out. I rewrote my estate plan, and you're no longer in there, my friend. I'm sorry to tell you that.
I was 100% confident I was not in it before.
Oh, okay. I didn't know if you're counting on it. So I just want to make sure you're fully aware. That's all.
I'm fully aware that you are, and I'm not in yours, and my mom doesn't have enough to leave anything. So I've known for a long time that I was on my own. And so
my list, by the way, is long enough for the people that are waiting with their hand out after years of torture.
That's why I'm waiting
until
70 to take Social Security.
I think that's smart.
For that extra 8% per year. You want another question? I got one that came in. It came in after hours, but it came into 855-935-TALK. And I haven't heard it, so I don't know what they're going to say. So here you go.
Oh, gosh.
Okay. Wait for it.
Someone convinced my coworker to change his 401k investment from a target date fund to this fund, SNVXX. He is 46 years old. Can I have your opinion on that? Thank you so much. Bye.
Okay.
Is that Frank, I'm assuming?
I'm going to try that again because
FN.
Good thing I can re-listen.
Can I have your opinion on that?
Oh, wait.
It's not
FNV state fund to this fund, SNVXX.
SN.
He is 40.
Okay, I got it now, I think. Yeah,
Schwab
the Schwab money market? Come on, no.
Oh, so somebody said, with this market.
Time to get out of the market.
Time to get out of the market and go to money market.
I think we started the show with this, something about being in a recession and what do I do now?
Yeah.
Tear up all your paper investments.
This is what you get for getting advice from a friend.
Yeah, move away from that cubicle, move down the hall or something. That's abhorrent. That's a market timing
advice.
Strategy, and you just, when do you get back in? The whole thing.
Well, here's the question you ask your friend. You say, now, okay, so you went to cash. You're making pretty close to zero because that Schwab fund.
Yield on this?
What is the yield on that? You're making close to zero. When do you get back in? Does your friend actually know the day when the stock market is going to start going up? Because I'm pretty sure, let's see, this came in on the 16th. So if he went into cash in January or maybe December, your friend has already missed out on it's been a big bounce in the stock market of about 5%.
Yeah, exactly. Even the S&P is up 3.5%. You missed emerging markets 7%. Yeah, I'm trying to find the.
What's the symbol again?
It's SAM, N Nancy, V Victory, X-ray.
X-ray. I'm not finding an SNVSX.
No, SXX. SNV. I'm trying to find the. Here's the. Well, it's Sam Nancy Victory XX.
Nothing.
It's the Schwab money market, and it looks like the yield is 1.3, which is more than I would have thought. So, but no, that's a horrible market timing strategy, not one you want to undertake.
It only sounds good when you compare it to.
Well, you feel good
to Bank of America.
When the market's down.
That's the only reason.
Yes, it does. And by the way, I think you said you just opened a new account somewhere. You're getting 4 on your money. I mean, that's a lot of money.
We sold our Nissan because we've got the two mini SUVs. We've got too many mini SUVs, apparently.
We don't drive that much.
And we don't. I work at home. Debbie doesn't have a job. She's retired. So, she'll go shopping.
Yeah.
But I don't go anywhere. And if we go places, we usually go together. So we're sitting here with this car that in the 3 years we've owned it, I think we put 6,000 miles on it.
Which is about what I do a week. Yeah.
And we were paying for insurance. So we sold it and we get this, even though used car prices are going down.
They are gone down. Gone down.
Even though we paid through Carvana 3 years ago, $20,000, $20,500 for the car. Sold it to CarMax for $19,600.
Good deal. We got time for one more call. We got somebody waiting.
You got a caller? Oh, well, I didn't see
Scott.
him. Scott, you're
Let's
up.
go to him real quick. Yep.
Hey, Scott, welcome to Talking Real Money. Scott?
You sound worse than I do.
Yeah, it sounds worse than I do, and I've got a bug. We can't hear you, Scott. Tell you what.
Sorry.
Call us either next weekend on Saturday.
Or you can call right after the show.
Or call after the show and leave a message at 855-935-TALK, because we're having a little technical glitch.
You want to pot him up again real quick to see if it works?
Scott?
Okay. Am I here?
You're here. Okay.
Yeah, go, man. Yeah. What do you got?
What you got?
Let's see. I am no longer employed in state government, but I'm trying to figure out where to roll my MEBT, my state retirement, and my savings account into one local spot.
Into one.
We can't move your savings account into an MEBT. I mean, MEBT is qualified money, I believe.
No, he's asking where to move all of these things. He wants to move them all to one company. He just wants them all.
Are you going to manage this? You manage this on your own, or are you going to hire somebody to help you?
Well, one of the other accounts I have is an inherited EJ account, and I'm not happy with that at all. So
EJ, you know EJ?
Yeah, we know who they.
We know EJ. Yeah, you don't want to do that. No. You don't want to do that.
So your options are if you're going to do it on your own.
Together, we're talking about $450,000. I own my home. I own my cars. I have no debt.
Well, there's two ways to approach it. There's the DIY approach, doing it yourself. You open an account with Schwab. You build a diversified portfolio, all that kind of stuff. There's the other approach, which is you don't hire an EJ or an ML or whomever or an MS.
Please.
You hire a 100% fiduciary fee-only advisor. And we have the names of some very good ones at our website, TalkingRealMoney.com. You go to TalkingRealMoney.com/help, and there's a list of great advisors, including us. We're on the list, but some very good ones, and interview some advisors, because a lot of people, when you get to your point in life, need advice.
And they'll be very happy to help you with $500,000. That's
Are we not doing traffic?
Apparently not. I don't know.
Okay,
about going to the top of the hour.
Sounds good. I mean, I'm just trying to figure out where to go the next step in life.
Yeah.
So go to TalkingRealMoney.com/help. Not only will you find that list, but you're going to find a whole lot of information on how to choose an advisor. And this is not just for you. This is for everybody listening. It's so hard to choose a good advisor, because
it is.
You're getting inundated.
Yeah.
You're getting just pounded with bad information. You go to church, you got somebody there, like the guy a little while ago, his friend.
Cubicle.
Yeah, the friend next door who said, "Oh yeah, get to cash. Go to cash right now." What stupid advice! You
don't want to do that.
Yeah. All right.
Good point.
Thank you so much. We appreciate your call. And remember to call us at 855-935-TALK. And also remember, come visit us at Retire Me. This is the one time a year where Don gets on a plane. This is it.
And gets off.
I get on a plane.
Yeah.
I
He'll be there.
stay on it all the way across the continental United States until somehow, just before we fall off the edge of the earth, we land in Seattle. Because, across the ocean, there be monsters. So we land right there. I get out of the plane. I go to Bellevue. I walk around the room going, hey, look, people do listen. And I talk about financial physics, and you have a really good time. And it doesn't cost much, or you can just do it for free online by going to retiremeet.com.
But it's more fun to come there. If you're not in the Seattle area.
If you're in the Seattle area, you want to come.
You should be coming.
And seriously, only 200 people. That's all.
That's it. Yeah, we've got a smaller room. So the 25th of February, you're one of the speakers. Paul speaks. I speak. Paul Lupesco speaking.
Paul speaks.
Barb Devereaux on long-term care. This is an all-star lineup. It really is, truly. And
are you sure Paul's coming back?
He says he is. He's in California now. He's turning and coming right back. He says
guy just keeps moving. I don't know how he does it. And I swear he's part fun. He's part Android.
There'll be a few surprises.
He's artificial intelligence.
Don won't know about that.
Oh, I have a surprise for you.
Oh, okay. All right. Then I'll show up. Okay, I'll show up.
Oh, yeah. You got to miss. No, you don't want to miss retirement. This could be, because I'm getting old, I'm good. I'm going to be more daring.
You pull a surprise? Okay, more daring. Okay.
I'm going to be more daring than I've been in the past. Because
you're going to find another
what are they going to do? What are they going to do? Fire me?
Yeah, exactly. Nothing they can do. So join us. Right now, and all kidding aside, you can get early bird tickets, I think only for another week or something, right? Anyway.
If the bird gives them up.
The bird is the word. So go to retiremeet.com, register today. As Don said, if you're in the Seattle area, come and see us in Bellevue on the 25th. If
the sandwich is great.
Yeah, it's fun. And we have a good time. It's nice to meet.
And the sandwich is great. Are we doing our show live from Maiden Bower, too?
We're doing the show live from there, too. We got to figure that out, actually.
I know how to do it.
Okay.
You just have to buy internet.
I'd get a tin can and a piece of string to try if I was doing it. Join us. It's going to be a great day. We hope to see you there. Retiremeet.com.
MEET or MEAT.
I can't see the clock, so I don't know what I'm doing here. So
we're done. Go.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future, so past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That's a wrap.